Ethical investing might be the easiest way to get ahead of popular trends and make a huge amount of money in the process. Thankfully, it's easy to get started as long as you understand a few key things I'll go over today. But there's also a cohort of people who are violently opposed to these kinds of investments, and so we'll talk about why that might be a little bit later. Investing at its core is optimistically hoping on companies being more profitable in the future than they are today. When a company that you've invested in becomes more profitable, typically their stock price goes up, and if you own that stock, that means the value of your investments go up. Another factor that can make a stock's price go up, especially in the short term, is just the opinion of large groups of people. We saw it happen last year and the year before. If we all believe that a company is great or at least worth investing in, then the price can go up a lot. And that might be happening here and now with ESGs. Let's talk about it. But what are ESG companies and how do we invest in them? Well, ESG stands for environmental, social, and governance. And what that really means is that we're choosing to invest only in companies that have shown to care about those three things and act on it. Environmental relates to how a company meets certain standards like renewable energy use, animal welfare, and reducing CO2 emissions. Social relates to how a company meets certain standards like corporate social responsibility, supporting local communities, and data security. Governance relates to forces both internal and external that control a company. It's about power dynamics. So that structure is set up, and that's all fine. But the next question to ask is, who decides what qualifies to be classified as this kind of company? Like, how do you get in or out of that group? Well, there's third-party organizations that give companies a score, and that tells the world whether or not they're playing by these rules that make it a great ESG company or not. Wait, that all sounds complicated and nitpicky. How did we get here? Don't companies just do what it takes to make money? Isn't that the point of a company? Why should they care about some independent third party giving them good or bad grades on these kinds of very specific metrics? To understand that, we need to see where we've come from. Companies nowadays are taking more responsibility for the impact they have on the people and the world around them. More and more people are thinking that we should take care of workers and not let them get taken advantage of. We should take care of the environment and not act like we can just do whatever we want to the world and there'll be no consequences and there's no generations coming after us, so who cares? That's just not the case. We should be aware of corruption and strive to be as ethical as possible. But the companies that are responding to that kind of sentiment are actually responding to a shift in public opinion that's been happening for the last 70 plus years. You might have been like me and thought, no way, this kind of thing is new. This is newer thinking. It's being led by the young Gen Z, Greta Thunberg types on their social media pages and their frustration with old people being so selfish and old and backward thinking. I also initially thought it was a more recent development, assuming it really emerged like in the last 20 years, maybe 30 years tops, because in that time period we've talked more and more about things like climate change and workers' rights and different things like that. So it feels fresh, it feels new. But you and I would both be wrong in that because this has been brewing since the end of World War II. Despite authors writing about the importance of nature in the late 1800s and into the 1900s, i.e. Henry David Thoreau, John Muir, Rachel Carson, we chose to absolutely dominate nature in the early 20th century. We had experienced an explosion in new technology that allowed us to engineer, build, and grow like never before. We leveraged the planet's resources to improve our quality of life by mining resources, building cities, roads, dams, and factories, and generally creating whatever else we wanted by any means necessary. We fueled our expansion with boundless optimism and a belief that we could have it all without worrying about consequences. That strategy also included how employees were treated. Child labor was common. Working conditions were basically not worth talking about, and people were generally treated more like disposable cogs in a much larger wheel than valued members of a team. It was also common for companies to be led entirely by tiny groups of people that prioritized only their own interests, and that sometimes came at the cost of their integrity. Cough, John D. Rockefeller, cough, cough. That meant doing things in such crazy ways that laws literally had to be invented in response to combat that kind of unfair and unethical business practices. But slowly, over time, things began to change. Let's go over the three major areas of change that encompass what it means to be an ESG company. First, environmental changes and repercussions. That somewhat blind optimism of the early 1920s slowly began to wane when people started dying. In 1948, 20 people died and over 600 went to the hospital in Pennsylvania after a nearby steel plant emitted sulfuric poison into the air. That tragedy led to the first U.S. conference on air pollution in 1950. Over the next few decades, smog continued that trend and killed thousands of people and drew the attention of numerous organizations and presidents. As early as 1952, an article called Resources for Freedom outlined the risks associated with U.S. dependence on foreign oil and called for the potential of solar energy to fill the need instead. Very forward thinking. The first Air Pollution Act was passed in 1955, and in 1965, the Motor Vehicle Air Pollution Control Act was passed, which regulated how much emissions were allowed to be produced by automobiles. We're used to it now, but that was the start. And in 1970, President Nixon established the Environmental Protection Agency, or EPA, and the trend continues to this day. You get the picture. More and more rules rules passed at a government level to make sure that the environment is protected and clean. The overall goal for environmental stuff in terms of a company is that they're doing business in a way that allows the healthy living of people and animals in the future that are around the business, that are touched by the business. The people that are doing business then need to be as creative as they need to be to ensure that they don't kill people by manufacturing their stuff or pollute some lake or whatever just to save money on waste disposal. The E in ESG takes that a step further and says that for companies to get a great score, they need to be truly excellent in terms of their environmental impact. They need to be aware of direct threats to their business, like if they are polluting that waterway near the factory because they don't want to pay for waste disposal, that's a problem. So they need to mitigate that. But there's also more indirect things like, will climate change result in a shortage of a critical resource that company depends on? If so, how do they engineer around that? What about things like, will government regulations continue to grow and end up encroaching on the business? Well, they need to do something about that now. And in return, they'll get a good ESG score. Environmental issues include factors like carbon emissions, climate change vulnerability, water sourcing, biodiversity and land use, toxic emissions and waste, packaging material and waste, and electronic waste. An example just came to mind. If you are an Apple customer and you have an Apple iPhone, then you've experienced this lately because Apple stopped shipping the little power bricks that come with phones unless you specifically wanted one, because it would save waste and save packaging and save all this stuff. And so they're trying to make steps in that direction. The next quality of ESG is S. S for social. Corporate social responsibility has experienced a similar rise in popularity and rise in people talking about it over that same time period from the 1920s till now. What that means in normal language is that companies choose to not just focus on making as much money as possible, but they also spend time and money to improve the lives of the people in and around the company, doing things like encouraging employees to volunteer for good causes, donating to charity, and improving working conditions of their suppliers all qualify for improving their ESG score. By doing these things, a company is choosing to be accountable to itself, its staff, its stakeholders, the public, and everybody else involved. And yeah, that's got to be as much of a headache as it sounds. It sounds terrible. A lot of the times what that means in actual practice is that companies can't just seek out whatever the cheapest possible labor is, no matter what. And that's typically what we did in the past. I mean, we went from manufacturing a lot of things in the United States, having a lot of factory jobs here, having a lot of manufacturing in general here, to then people discovering, oh, outsourcing is a thing. Having a factory set up in a different country is a different thing. Like, for example, if you've ever read Shoe Dog by Phil Knight, it goes through the detailed process that he went through to outsource the manufacturing of all Nike shoes to another country. At the time, he was kind of paving a new path there by doing this because it was fairly uncommon, and it was this way that he had an advantage over other people. It was cheaper to get the shoes made there and shipped here. Similarly, Ford has done this a bunch. Ford makes a lot of vehicles in Mexico. Now, Ford used to do more of their manufacturing in America, but instead they realized they could have cheaper labor and cheaper overall production costs in Mexico, which means they've got more room left over for profit. Then problems came in more recent times whenever people looked at those factories that the shoes were being made in, or they looked at the factories where the iPhones were being made in, and they said, hey, we're not okay with you doing this, even if that means it saves us some money on the price, because you have to take care of these people. You have to treat these workers as people. And so in response, relatively recently in the scheme of things, companies have started to be more accountable to the working conditions for all their people, no matter where they're located all over the globe. Now, does this mean they're perfect? Does it mean that there's no problems with this and that everyone has a wonderful working condition and it's perfect? No, it's not that. But they're doing better, or they're at least making strides to do better. Here's an interesting little diagram, and it's called Carroll's Pyramid of Corporate Social Responsibility. And it basically just shows you the overall structure of what it means to be socially responsible for a corporation. It starts with economic responsibilities. Obviously, a business has to be profitable to survive, to go on as a business, so it has to do that. Next are legal responsibilities, so it has to follow the rules. This makes sense. Next up from that, and further from the necessity, is ethical responsibilities. So a company needs to be just and moral and avoid harm. It needs to kind of keep its nose clean. And then finally, at the very top of the pyramid, the most ideal, perfect condition, if everything else is met below it, is philanthropic responsibilities. So a company can give back to society and improve community life and do all these really nice things that we all like to see. And that makes sense, right? They have to survive to go the extra mile and help people. Even with their core business, there's ways they can flex their S muscles, their social muscles. Some examples of this more specifically are engaging in charity work, purchasing fair trade products, investing in environmentally conscious businesses, getting involved in volunteer work, improving labor practices like I talked about with the factories, worker safety training, supply chain labor standards, and consumer financial protection. The third and final part of ESG is the G, and that's governance. Now for me, this was the most cryptic part, so I had to work hard to break this down for you and kind of boil this down into something that makes sense. First, let's go back in time. 100 years ago, business was basically the Wild West. There were very few rules or laws around around what you could and couldn't do business-wise. Make a product or service happen, get paid, that's it. But times changed as people like John D. Rockefeller created problems with unhealthy levels of influence on high levels, as well as monopolizing entire industries. As a result of people like him and the corresponding court cases, policies were changed to protect normal people more. That's part of what the governance piece in ESG is related to. Basically, there were holes in the system, or there wasn't a system, and he was able to take advantage to a degree that hurt too many people, and he got caught, and then structures were made to protect us. Governance within a company relates to both how the business functions within the boundaries of government policy and the distribution of power and leadership within the company itself. Boards of directors, managers, shareholders in the company, basically anyone having a say on what the company does needs to be checked to ensure that the influence they have is fair and makes sense, because in the past it rarely did, basically never did. That may still sound kind of vague, so let's talk examples for the next 90 seconds or so. First of all, employee relations. This is asking, do employees have a say in what the company does? They should. Next, management structure. Is the CEO also the director of the board and basically has king-like dominance over the entire company? Or is that power distributed among leadership more evenly and more fairly? Because it should be. How about the compensation and oversight of top executives? We all love to talk about this. Are they paid insane sums and never questioned? That's not good for anyone but them. The G in ESG intends to measure that and give a corresponding score to reflect it. And that's also the makeup of the top leaders in the company. If every executive is a later middle-aged, super rich white guy from the Midwest, they may not understand how to care for a minority single mother as well as a fellow single mother would. Companies that have a diverse leadership team get higher ESG scores. Employee compensation falls under this too, and that's probably the topic that we're all closest and most relating to on average. More specifically, what this talks about in the G in ESG is equal employee conversation. Historically, women and minorities were paid significantly less than men who were white. And so that third-party MSCI quantifies that kind of data and it reflects it in the score of the company. Besides the pay part, this part of the ESG score feels like the least tangible to me, but it's actually super important. If the top leadership is badly structured, the whole company can crumble no matter how hard you or I work or how good the business is in theory. It has to be strong structurally and ethically, and the power system has to be good, or else we're all at risk, or our jobs are at least. Okay, now you know the history and the details of each of the three elements of ESG. Now let's talk about why companies care. This is all fine and good. They could do those things if they want to, but again, a company is here to make money. They are here to do business. Why should they care about getting a score from some third party? Personally, I see the corporate motives to be one of three choices. Number one, company recognizes public sentiment and they see the pressure is on them to do these kinds of things, and so in response, they do the things to shut everyone up and let them continue to do business as close to the same old way as possible. If they don't appease the public, then they'll catch the flack from the public, and that's not good for them. That's option number one. Option number two, the corporate motive could be to actually do good. They might be thinking, hey, we make a lot of money. Instead of buying another Bentley for everyone on the board, let's donate to charity or use recycled packaging or whatever. There really is a chance that they are genuinely interested in improving the environment or the working conditions of their people. And so getting a good ESG score is right in line with what they want to do anyway. The third motive is also, in my opinion, pretty likely, and that's to leverage the marketing potential of ESG and public opinion of it to increase profits. Treating the good buzz from a positive ESG rating as propaganda both inside and outside the company could really move the needle for them, could be very helpful. Outsiders may choose to do business with a company that has positive press, and employees from the inside may take more pride in working for a company that has a good reputation by doing right by its people. Overall, good PR. There's a chance it's a cocktail of all three of those motives, but knowing what you know now, what do you think motivates companies to work on ESG-related issues? Let me know your opinion in a comment. From publicly available information anyway, we can't prove that first motivation of just shutting everyone up is a driving force for a company, but we can read about how people think that it's a good marketing tool. For example, if you know about that brand that does some positive stuff for people, it's easier for you to recognize it when it comes time to make a buying decision. You've heard the name before. You've heard your friends talk about it. You think it's cool. So hearing about a company like Patagonia that will recycle or repair their clothing or encourages you to buy and own less and just have higher quality stuff might strike a chord. You might think that that's really great. I want to get behind that. A fourth possible motive that I had kind of overlooked in a PR, fire insurance kind of way is realizing that today's investors are less tolerant of ESG incidences or controversies or problems, and they may reevaluate their investment approaches if these aren't managed. managed. So if the companies are just blindly operating, doing things the way they used to do them, and they aren't conscious of the negative press that they'll receive if they slip up in those areas, they're actually ignoring a big risk factor to their success and their business. That is bad business, no matter how you feel about the underlying causes or the motives or anything like that, and they need to be aware of that. I think for a lot of these companies, it's kind of like this little visual, which is fair operating practices turns a cog, which in turn helps good community relations, which in turn gets workers and customers to be loyal and prideful, and it's all this kind of interconnected system that drives itself. On a deeper level, if a company can be self-aware and it can be agile enough to navigate the world of ESG well, and they can get the good ratings, they're likely able to do other things well. And that kind of logic is one of the reasons why a lot of investors today really like the prospect of focusing their resources on high-scoring ESG companies. So let's talk about that next. Why does someone like you or I, as an investor, care? Why do we want to invest in the future by way of ESGs? A lot of very smart people are predicting that big companies need to be good at this ESG stuff to be successful in the future. A report in 2016 by Bank of America predicted that millennials will invest between $15 and $20 trillion with a T in US domiciled ESG investments. 94% of Gen Z agree that business should be socially responsible, and 90% of shoppers are more likely to be loyal to brands that take their pro-social objectives seriously. So we have indicators here telling us two things. Number one, people who are entering their prime earning years are planning to invest a lot of money in ESG companies. And two, consumers want to do business with ESG companies, both of which should help increase the profitability and stock price of those kinds of companies, in theory at least. Another positive metric that investors are noticing is one that I just alluded to a minute ago. If companies are willing and able to realize what their place is in the world and mitigate their risk related to a little kind of moderately consequential ESG score, they're probably pretty darn smart and capable business people that can mitigate much bigger risks overall. That may dovetail into a more profitable, innovative, agile company in general. They could make changes to their products and services needed to suit the desires of customers better than a slow-moving old company that isn't willing to make any changes. We've always done it this way. Ultimately, if a business scores high on ESG metrics, many investors see it as being future-proofed. That means it's able to avoid so many different kinds of risks, and that instills a lot of confidence in people. Before we talk about how to invest in ESG companies, let's tap into this little subject here, which is that some people genuinely hate ESG investing. I'll go over this briefly here, but if you want a more in-depth video on the hatred of ESG, leave me a comment about that. Some people are mildly opposed to ESG investing as a strategy to make more money, and others are actually against the whole ESG idea fundamentally. Let's talk about the first group first, investors. Some ESG funds are actively managed, and so what that means is that a real live person, like you or I, who gets a salary, who gets bonuses, they have to make decisions about what investments are in that group of investments, i.e. the fund. This person gets paid for their work, and the company they work for gets paid a lot for their work, and so it means that we all miss out on a large chunk of our investment returns because they're being sent to those people instead of our accounts. That stinks, and I agree with that opinion. We also need to draw the line between two three-letter acronym investing things, ESG and SRI. We now know exactly what ESG investing means. SRI stands for Sustainable, Responsible, and Impact Investing, and what that is, in contrast, is choosing to invest in companies specifically that have a positive social impact. When we compare that to ESG investing, this is like choosing the companies that stand to improve society, where ESG is about choosing to work with companies that are mitigating risk in the E, S, and G areas best. They aren't necessarily the best for the world, they're just really great at preventing problems. Some people want to make that distinguishing factor really clear, because we may assume that by choosing ESG companies, we're really intending to choose companies more like those that rank well on the SRI scale. This concern makes sense to me, and I can see how the popularity and marketing of ESG could run wild and confuse people. Make sure that you know what you're investing in and why. Investors that don't love ESG also can claim that the potential upside of ESG investing in terms of making more money is a moot point. People are always seeking out the companies that will make the most money in the future and investing in those. Whether or not that company is on a list of goody two-shoes ESG companies makes no difference. The market as a whole will find and invest and exalt the best no matter what. So stop wasting your time. Okay, logical. Also, second to the last point, anyone investing with a short time horizon, let's say 5 years or less, shouldn't give a rip about making money by ESG investing, because by design, those things will only really matter in the long term. Those kinds of factors will only really play out in decades. So, okay, I can see the sentiment, I can see the logic. Finally, the last reason why people don't like investing in ESG is because ESG ratings are a distraction for the company away from the core business of any business, which is to increase shareholder value. If a company leadership is doing what they should be doing, they will already be aware of the risks that ESG ratings are relating to. They should already be mitigating those risks because they're risks to the business. no matter what umbrella they're under or what score is associated with them. At best, then, ESG efforts are redundant, and at worst, they're a cover-up for poor business performance. Smoke and mirrors. Okay, now let's talk about that second group of people, which are the skeptics, the people that don't like ESG as fundamental concept. Number one, they claim that corporate greenwashing covers up the truth. And this is a funny new term I had to learn. Greenwashing refers to intentionally misleading information that's given to the public to make it seem like a company is doing something that's helping an environmental cause, or in this case, an ESG related cause. And on the surface, the initiative looks good. But when you dig deeper, it's corrupt or at least kind of negative. So it's basically like bad marketing and bad PR. Number two, they claim that much of the data that makes up ESG ratings is self-reported. So by the company itself, the company will generate that data, which of course means that the door is left wide open for falsified metrics. And that means that the company can say things are better than they really are. Number three, people claim outright that companies that are rated highly on ESG funds support direct and violent damage of people groups in third world countries. This is pretty deep and pretty specific. And so my research that I could do online didn't let me verify or deny that like really unequivocally, but that was a claim that was made. Number four, they say the only thing ESG investing does effectively is make it slightly harder to exist as a non-ESG aware company, that it doesn't actually do much positively to change the world and move it forward. It just seems like an oversimplified marketing tool and a trick that will make people like well-meaning millennials send their money over there instead of over here. And that in the end, the marketing is really done by the investment companies. The investment companies stand to make a lot of money in fees. And so if they can market that to us and divert our investing money in that direction, maybe that fund has a higher fee, they make a lot more commission, they're happy. So these people are claiming that the investment companies themselves are trying to shift our opinion in that direction, not the companies themselves. Next, skeptics claim that the logic of investing in ESG companies or any environment-saving company can give the illusion to us that the act of investing itself contributes adequately to the overall goal of saving the environment, when really the action is about self-preservation. It's intended to save the portfolio, not the environment. There's a much bigger and different action required that will go on to save the environment itself. And so then this whole exercise of investing in ESG and feeling good about ourselves and patting ourselves on the back is a misnomer, and it's kind of misguided. Skeptics also question if ESG funds will ever become big enough and sizable enough to make a real noticeable difference in shaping the market and the motivations of the people at the top of these big companies. They claim probably not. Skeptics also question whether or not the experts that are in the financial industry and in the third parties that give these companies the scores are the right people to decide how we combat these social and environmental challenges. Maybe they're not. Maybe they're just finance guys, and maybe they don't know what the core problems really are. Whew, that was a lot of reasons. That was a lot more reasons than I thought initially. Ultimately, there will always be perspectives on both sides of the teeter-totter, and ESG investing is no different. If that negative perspective didn't scare you away and you'd still like to know how to invest in ESG companies, let's talk about that now. There's two main ways to invest in highly ESG rated companies. Highly rated ESG companies, however you say that in English. Number one, go through a list of companies that are on an ESG list and just pick the ones at the top. Pick the ones with the highest ratings and buy some of their shares. Maybe you look at the top 10 companies in the MSCI rating for this year and buy $100 of each company in M1 Finance. You make your own ESG portfolio. Very simple, totally works. And doing it this way for clarity is probably the way to avoid fees and avoid the most fees overall, because you're the one putting that together and you're not paying some investment manager guy who's choosing the fund for you. The second way is to take the easy route and pick from any of like dozens of ESG related index funds that do a lot of that work for you. Be aware though that some of these could be a lot worse than others, because this is a trendy thing. Millennials are planning on investing trillions of dollars. A lot of public sentiment is centered around this belief that companies should be responsible. And so it's not that hard to create a list, to create a fund, to make something look on a marketing sheet like, hey, you're doing something that's noble by investing your money in only these companies. But the investing fundamentals that I've talked about before in videos still need to reign true here. We have to look at things like fees. We have to look at things like, is this fund well diversified? If there's only like 12 companies in the fund and the fee is 1.25%, that's a scam. That's a ripoff. I mean, it's not really a scam, technically. Scam is too strong of a word. I would say it's unwise to invest in something like that because you're paying a very high fee for something that's very simple that you could have put together and paid zero fees on. In the scheme of things, it wouldn't be that much work for you to go through and handpick your own companies, or just to look at the top lists of, hey, what is that ESG fund made up of? And then go and copy that into your own kind of fund. This kind of thing is totally doable and helps you to avoid fees. So at least consider that if you're interested in doing this. If you do want to take that easy route and you want to find a fund that's kind of pre-built for you, you could go into M1 Finance and type in ESG. Something like that would be really simple because there's a lot that have like ESG in the name. And then of course you could go broader and just Google ESG investing funds and get kind of a bigger swath that way. Probably the easiest safest route overall is within Acorns, because Acorns added a whole portfolio that's only ESG. So it's sort of an on-off switch. You can either invest with all the companies, or you can switch it over to ESG mode and only invest in ESG funds and ESG companies. So that's like the least amount of work and the most amount of fees probably to do it that way, but you got to pay to play. Overall, if you want an investing service that I'd recommend personally, I'm using M1 Finance the most these days. They allow a lot of control, but they're designed to give you a long-term outlook on investing, which I love. They're as easy to use as Public or Robinhood or a bunch of others, but they aren't focused on day trading. And if you want to, you can look up some detail, and you have a lot of good features, but it's not difficult to use like Webull or others along that vein. So it kind of strikes a nice balance there. If you do want to get started, look for a link in the description and go ahead and click on that to download the app or get started on your computer. To be totally transparent here, I am investing in some ESG companies. Doing research over the last few weeks, it has really opened my eyes to the potential shortcomings of ESG, because I think I thought of it in terms more of SRI. Like, I thought that these companies really were, I think, a little bit more noble than maybe they are, because they are just seeking a score. They're not necessarily having to accomplish certain big missional things. They're just saying, hey, we've mitigated our risk, give us a score, man. It's not to say that they're only that, because there's companies that could be both. They could get a good ESG score and they could be doing really great things in terms of SRI as well, but it's just a little bit more muddy than I initially thought it was. Of course, as we dig into anything in more detail, we find out that things are a little bit more convoluted and a little bit more detailed than we initially thought. I think for now, I'm happy with the amount of ESG investing that we're doing, and in the future, if anything, I might want to research SRI investing. I think that if my money has to go somewhere, I'd like it to do good, but I also primarily need it to make me money. So we'll weigh that out in the future and see if it makes sense, but for now, I'm going to leave the ESG money where it is and then keep investing it in the ratios I kind of have. If you've made it to this point, I appreciate you so much, and I'd like you to have a secret comment with me here today. Today, the secret comment word is monopoly. Talked about John D. Rockefeller, who created crazy business things and went through loopholes and did all this nutso stuff, which basically meant, hey guys, we have to guard against monopolies here because it's not good for the overall business world. And so today, the secret comment word is monopoly. If you enjoyed the video or you learned something new, include monopoly in your comment, or if there's some kind of emoji that has to do with monopoly, that'd be interesting too, then go ahead and leave that, and I'll keep an eye out for these because they are my favorite comments by far. I mentioned M1 Finance as my preferred, recommended, best overall kind of trading app, and so if you want to see a 2-year review of that, it's right here. If you're interested in knowing a little bit more about ESG in terms of what Acorns offers and how Acorns structures it, it's this video right here. Also, if you're not, please subscribe. Thanks. See you soon.